Hi, and welcome to Macro Monday, where we talk macro and try to make sense of markets that people apparently just want to bid up like crazy. You know, I'm your host. Steve Van Metre, and thanks for joining me today. Because really, I've got some special announcements. But before we get to that, the market really reminds me of the dot-com bubble. And some of you are too young to have invested in that. Some of you, obviously, listening have invested during that. And for those of you that were alive, you remember that tech stocks could do no wrong. I mean, valuations were just, that don't even matter, just bid the stock prices up. And as I watch people bid prices up today, it kind of makes me wonder, do they even realize what they're doing? I mean, do they realize that at some point they bought forward earnings so many decades in advance that it's going to take forever to get their money back? Or, I mean, stock prices eventually come back down to some sort of reasonable level. And what happened after the dot-com bubble is investors really were made fun of. I mean, the media came out and said, shame on you. You should have known better. You should not have bought these stocks with astronomical PE ratios. You should have done your homework. You should have known better. And I just feel like that's all going to happen again. And I obviously don't know what day or when it'll coincide with the dollar going suborbital, because I am a massive dollar bull. And yes, I know day to day, I appreciate those of you keeping me updated on where it's going every day. I am aware of that, but thank you. It just makes me wonder, do people actually think long term, or do they just throw money in this market and expect it to just go up forever? My guess is they expect it to go up forever, just like they did during the dot-com bubble. But when that final, plug got pulled on that market, it was shame on you. You should have known better. And yet people just can't help themselves. They have to play chase. And I look at these stocks and I just wonder, like, when are people going to actually get their money back if they're a long-term investor? I'm kind of thinking, well, long-term could be 20 some years from now, for all I know. Now today, exciting news. I sat down with Brent Johnson for an hour-long interview for Real Vision, which will be debuting on, legendary, he said not to call him that, legendary Brent Johnson of Santiago Capital. He did actually say not to call him that. Anyways, we sat down for an interview. It was phenomenal. It'll air on Real Vision at 9 a.m. Pacific, noon Eastern on Wednesday. Now, for those of you who do not have a Real Vision subscription, need not worry. 2 weeks from now, it will show up on YouTube. So if you're not following Real Vision's channel, hop on there. And to my wife and father who are listening, don't worry. There's a special friends and family link so you can get through and watch it ahead of time. So with that, you'll be excited because I did actually mention how great all of you are and the fans I have here. So I appreciate that very much. I've also been invited back on Johnny Bravo. Don't have a date set, but knowing Johnny, it'll come pretty quick. So I'll coordinate that with him hopefully tonight. And many of you have been asking and waiting and hoping. That's right. I got an email from one and only George Gammon. So we'll get that set up. I'll keep you up to date on when that interview is going to happen. I haven't had a chance to get back to him because I really wanted to prepare and do a great job for Real Vision. And I hope they're really happy. And I hope when you see it, you're really happy about it too. Now, I'm still not done with this dollar bearish thing. I know a lot of you don't agree with me, and that's okay. That's what makes a market, right? You got to have people on both sides. But one of the things that I'm not sure some of you really grasped was you said, hey, you took that chart of the monetary base and it was an after the fact look at the dollar moving up, and that's chart crime and you cheated, and okay, well, let me show you how that wasn't exactly the case. Yes, I understand how the chart looked, but what you don't understand perhaps is a rising dollar signifies tight or tightening financial conditions. We already knew the dollar was going to rise. How? Because there's these massive amount of repo loans or dollar loans where commercial banks could come in and trade in on loan their treasury securities and mortgage-backed securities for dollars. So we already knew there was stress in the system. And when you take that chart of repo here in blue and the trade weighted dollar in red, what you could see is as repo exploded, which signified tight financial conditions, well, so did the dollar. They happened simultaneously. Yes, now granted, the monetary base follows it slightly because at that point the Fed is being reactionary in slamming on the QE gas, and that just adds to the tightening of financial conditions because we already know that QE pulls liquidity from the markets. It doesn't add liquidity. And why does it pull liquidity from the markets? Because the banks do not actually receive the money from the bonds that the Fed buys. The money the banks get, so to speak, goes into a collateral account at a Federal Reserve member bank with their name on it that they cannot withdraw from. So effectively, QE pulls liquidity. And here you can see that the dollar and the repo spike happened simultaneously, and the monetary base was following it right behind it. So going on about the dollar, let's keep digging into it. What causes that spike to keep going? Well, a collapse in interest rates. So what we have here is the federal funds rate, and you can see the repo started to spike and the Fed tried to stay on top of it and really dropped interest rates. And again, what do low interest rates signify? Tight or tightening financial conditions. So what's going to happen next time, and why does the dollar go higher then? Because the Fed's not done yet. The economy is not back on solid footing at all. So they're going to have to do more QE. And what does QE do? It causes interest rates to go up or down. Which one? Boom, you got it. It causes them to go down. And then it causes the dollar to go up. And then you get a tightening of financial conditions. And that's how it all plays out. We should see that happen again. Probably not too distant future, because once Treasury yields break through on the 30-year, say around 1.2%, maybe even slightly before, you're going to see the system rumbling and shaking and falling apart. Would not be surprised if we see a return to repo at that time. It's possible. Who knows? But when you see repo loans, anytime you see repo or dollar shortage in a debt-based economy, it means the system is fracturing. And the system hasn't been improved. The only thing that's changed is everybody's front-running inflation by piling into stocks, taking leverage into stocks, piling into risk assets because they think massive inflation is coming. And just like with every market peak, at some point investors find out, no, they're on the wrong side of the market. It's deflationary. At its heart, our monetary system is deflationary, especially when you factor the laws around the Federal Reserve, all the constraints put on the banking system. The system is highly deflationary. And that's why I don't care how much QE does, it doesn't create inflation, but the more they do, well, farther yields are going down. So I wanted to take a look at that and kind of answer some of those questions. Let's take a look at how hedge funds managers are positioned. There was a question I saw on Twitter. I think it had to do with why is a smart money long or short or on the equity side? We'll get to that. But let's take a look at 10-year Treasury note futures. So they went from neutral the week before, back up where they were. So hedge funds are now slightly net long. Now remember, we're not going to see yields bottom until hedge funds are far longer than here. So 10-year Treasury, despite claims that it is going higher, it's actually headed lower. We see the same thing with the 30-year, except they backed off slightly off their record short position. So if you want to look at just dry powder that's going to launch 30-year yields into an abyss and 30-year bond prices straight up, wait till all of this gets unwound. And you can see going back to 2018, when it got unwound, it dropped yields from almost 3.5% down to 2.5%, so almost 1 full percentage point. Well, and they were only slightly long. Wait till this goes from here all the way up here. If it took a 1% move to get that, guess what? We're sitting pretty much at zero by the time the hedge fund managers are net long. So again, if you're looking at deflation and seeing how this plays out, you got to look at this chart and say, yeah, this is pretty awesome, because everyone's pretty much gone all in on this higher interest rate deal. There's really not much more push they can get out of this, and we can see that in the price action, which we'll take a look at shortly. How about West Texas Intermediate? We're seeing speculators are backing off their long position, but they're still very, very long on crude oil, and maybe they'll get some validation due to the storms hitting through the Gulf of Mexico, but still demand remains weak. How about hedge funds? So here's maybe the question is, why would the smart money be long? Well, perhaps they're so short stocks, meaning they've sold a lot of their stocks, that they are taking a small long position just in the off chance they're wrong. So that could be the case. But there's not a lot of conviction here on either side with the hedge funds net short still. We do know hedge funds are very long equities in holding those positions, so it's not surprised they're hedging their short side a little bit. How about the euro, which is trading opposite the dollar? Massive long position, no real change here. Again, you have an overextended position on the euro. This gets reversed, and that is going to be a dollar catapult going higher, and that should send gold lower, even though gold is still quite long. And some people ask, well, why are the commercials net short? Well, here's why. Because the commercials are really happy to be selling at this price. You know, if you're a gold mining company, you got to love this price. And so what do you want to do? You want to be net short, so that way all these people up here that think gold's going higher, they're going to pay that price when it goes down. So they're locking in these high prices, which is pretty cool, and why commercials are net short there. How about the NASDAQ? See speculators are net long a little bit, still driving tech stocks higher, as pretty much short positions on the major equity index are very low. I don't know I think they're at least at the decade plus low. So people are pretty much have gone all in U.S. equities. Russell 2000 slightly long. How about the dollar? Still very short position on the dollar. On multiple scales, you can see this thing, and we're not looking at them here, but is massively oversold and drawn down. We're going to look at what's going on in the dollar as a bottoming pattern, and it's pretty interesting. And we see, of course, volatility. Of course, naturally, if hedge funds and other speculators are long stocks, they got to be short volatility, and they've got to be short the dollar. And that's what they're doing. They're shorting volatility and shorting the dollar to drive equity prices into nosebleed level and beyond as people pile in. And it's crazy because, usually that means people are eventually going to lose a lot of money. All right, let's take a look at the bond market. Moving up to 30-year Treasury yields. Started the day below its 100-day moving average on the 30-year. Briefly got below its 50-day and then came back up and reconfirmed its 100-day moving average, which is sitting at 1.359. And so I don't know the exact close, but it's pretty much right around the 1.35 level. And this is not unusual to see that once a moving average is crossed over, price, or in this case yields, rise to confirm that it's not going through. And if it doesn't, then it heads back lower. So moving averages, while they're just a moving average, tend to act as a level of support and resistance in the short term. So today's move is not really a big deal. We do expect this to continue to go lower because, again, there's no lending growth. Taking a look at the mirror of that TLT, we saw it came up today, tagged in the middle of this resistance line. So here's, some of you love the football analogy. So the defense pushed back, and then the offense, finally wore the defense out a little bit and pushed the ball back off the 25. So the defense did back it up, still holding above its 100-day moving average, below its 50-day in green. And I imagine that in the days that follow, we will see bond prices continue to rise. There's no QE auction tomorrow, but QE returns on Wednesday and Thursday, and then on Thursday we get a new schedule for the QE. All right, let's check out the dollar. And here is the bottom of what looks like a bottoming of the dollar. And I want to go look at this chart from Wykoff. Now, this is really great, because this is one of the oldest forms of identifying market bottoms, was from Richard Wykoff, and this is the standard accumulation schematic. And so price comes all the way down and finds a bottom, and it oscillates in there, and then it makes a new lower low, and then kind of bounces kind of up near the top of this trading range. So you see trading range, resistance lines, trading range, support lines. And then it kind of slowly leaks down, looks like it's going to fall off, and then springs higher, comes back up to the top end of the training range, kind of looks like it's going to break through where everyone gets excited. It pulls back, and then it launches out of there. Now let's take a look at what's going on with the dollar. So it came down off of this massive slide, finds a bottom and bounces off, comes back up, bounces around a bottom, comes back up into that trading range. Now let's go back and look. So what did we see here? Comes back down, finds a bottom, comes back up, finds bottom, back up in the trading range, and it kind of makes a slight new low here, which it did. I'm trying to juggle between my screens. Right here makes a slight new low, then kind of bounces back up into that trading range and then dribbles back down to make a new low. Let's see. Bounces up into that trading range, so in here, and then dribbles down low to make a new low, and then pops up higher. So what would we look for in here in the dollar, which appears to be, gosh, this is a lot harder than it looks. Try to jumble those, switch between those screens. So what does this look like? Is we're seeing it bounce kind of at the bottom end of that trading range around 93.40, and it pulled back, and it suggests now that we should, in the days that follow, see a move into this trading range or supply zone, and a break at 94 tells us that the accumulation pattern in the dollar is done, and we should see higher prices. So this is pretty interesting that it takes on the shape of a nice Wykoff bottom, and I appreciate the whomever it was that sent me this. I had the PDF already, but they sent me some information on it, and I thought, man, that's really, really super cool. So where does that leave us with today's episode? Well, be sure to like, even if you don't agree that the dollar is headed higher, and subscribe. Make sure you also jump on the Real Vision channel so you can catch that episode when it comes out 2 weeks from Wednesday. And with that, hopefully we'll find some more economic data to talk about on Wednesday and see what's going on with the bond market. I'm Steven Van Metre. Thanks for watching. I'll see you then. Bye now. The content of this video provides education information only. It's not intended to provide investment or other advice. Material is not to be construed as a recommendation or solicitation to buy or sell any security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity, and opinions expressed in this video that do not reflect the Atlas Financial Advising or Steven Van Metre Financial.